FHA loans can buy raw land and build a house on it, finance repairs straight into the mortgage, or get you into a HUD-owned home for $100 down. But almost everything you hear about FHA stops at the 3.5% down purchase loan. None of that requires perfect credit either. A credit score in the 500s still qualifies for FHA financing, but it costs more at closing. Hi, I'm Wade Betz, Chief Strategy Officer at Empire Financial. I've closed FHA loans for buyers rebuilding credit after a rush stretch, first-time home buyers with nothing saved, and clients who built a house from an empty lot. Each one comes with real requirements, and I'll walk you through what qualifies for each so you know where you stand before you talk to a lender. Rates are still keeping buyers on the sidelines for now, so these 6 paths matter more than ever. We'll start with the one that decides whether you qualify at all: your credit score. FHA runs a sliding scale for credit and down payment, and that scale decides everything else in this video. A score of 580 or higher gets you into the standard 3.5% down option. Drop into the 500 to 579 range, and FHA will still insure the loan, but the down payment requirement moves up to 10%. So I had a client who'd been through a rough financial stretch a couple years back. He hadn't missed a payment on any installment or revolving account in the year and a half before he applied with me, and he'd saved enough down to cover the 10% plus a cash reserve on top of it. That combination is the profile FHA built this tier for. What actually stalls a buyer in the 500s is usually that extra 6.5% down that they need saved up for a larger down payment that credit tier requires. So here's what you do. Pull your scores from all 3 bureaus, look back at the last 1 to 2 years of payment history on any installment or revolving account, because a late payment in that window is usually what costs someone the lower tier. So if you're under 580, plan on putting 10% down instead of the 3.5% and start setting that money aside now. Build a small cash reserve on top of it too, because underwriters will want to see that cushion at this credit tier. Even at the 3.5% down option, that's real money to come up with before closing, but there's a specific way to close that gap without derailing your savings. Down payment assistance programs exist specifically to close the gap between what FHA requires and what a buyer has sitting in the bank account. The money usually comes structured one of 2 ways: a grant that never gets repaid, or much more commonly, a second loan that gets forgiven the longer you stay in the home. A lot of buyers who use this qualify for the monthly payment without any trouble, but years of rent have eaten into what they could have otherwise saved towards a down payment. So down payment assistance is what gets them to the closing table anyway. So ask your lender which down payment assistance programs are active in your state or county, because they do vary by location. Some are hyper-local, some are statewide, some are national. Most of them come with a higher interest rate associated with it, and that's the trade-off. Again, down payment assistance programs exist to help bridge the gap between the funds that you have versus the funds that you need, but it usually comes at the expense of a much higher interest rate. Now, most of these down payment assistance programs run their credit requirements a little bit higher than a standard FHA loan, so plan on the low to mid 600s instead of 580. Now, a number of these programs need the seller to agree to specific contributions, so build that into your offer before you're already under contract. Ask directly whether the money is a grant or a forgivable second mortgage, and what triggers repayment if you sell or refinance early. Again, down payment assistance closes the gap on a normal purchase, but for buyers willing to look specifically at HUD-owned homes, FHA has a program that shrinks that gap down to $100. When a home financed with an FHA loan gets foreclosed on, HUD ends up owning it and wants that property sold quickly. So on certain listings, HUD will accept a minimum cash investment of just $100 instead of the usual down payment. This only applies to specific homes HUD already owns and has flagged for the incentive. Search HUD's home store listings for properties in your area. Confirm the specific listing is flagged for this incentive. You'll still meet FHA standard credit and income requirements, but budget for closing cost and prepaid items separately, as those are not rolled into the $100 down payment. Only the upfront mortgage insurance premium can be financed into the loan. So this program only works on a home already owned by HUD, but FHA has a different tool built for a home you find yourself that happens to need work. The 203K loan lets a buyer roll the cost of repairs into the mortgage itself instead of paying a contractor the cash on top of a down payment. It also works for homeowners who want to refinance and renovate a home that they already own. There are two versions. Limited 203K covers up to $75,000 in improvements and skips the requirement for a HUD consultant. A standard 203K is for major work. Think structural repairs, additions, that kind of thing. And that needs at least $5,000 in repairs and requires a HUD-approved consultant to manage the draws as work gets done. So a lot of the best-priced homes on the market need work, and buyers walk away from them assuming repairs mean cash that they don't have sitting around. So figure out first whether the repairs are cosmetic or structural, since that decides which version you're using. The same credit score tiers from earlier apply here too. So 580 and up gets you 3.5% down, 500 to 579, you'll need 10%. So this loan also works for homeowners who want to refinance and renovate a house that they already own. But buying a home that needs work is one path, and building one from scratch without paying for two separate closings is another way FHA gets you there. A typical construction project needs two loans, one short-term loan to build the house and a second loan to pay off the construction loan once the construction is done. That means paying closing costs twice, title fees, lender fees, and paperwork included, but FHA's construction to permanent option rolls both into a single closing before the first shovel goes into the ground. A buyer who already owns their lot free and clear can use the value of that land towards the down payment requirement instead of coming up with fresh cash for it. You'll need to contract with a licensed general contractor, since FHA doesn't let you act as your own general contractor unless you're licensed yourself. So if you already own the land, its value can count towards your required investment instead of needing separate cash. Budget the same tiers as before though, 3.5% down at 580 plus credit score, 10% down if you're below that. So ask your lender what credit score they want to see for construction underwriting, because many lenders set their own bar higher than FHA's minimums. All of this so far has been about buying or building, but the last one is for anyone who already has an FHA loan and just wants a better rate without redoing all of the paperwork. This only works if your current loan is already FHA insured and current on payments, and it's built to cut down on the documentation a lender normally requires for a refinance. FHA requires the new loan to actually leave you better off, which is called a net tangible benefit, and it has to be there for the refinance to qualify. So someone who financed at a higher rate than what's available today can lower their payment without a new appraisal or income documentation, depending on which of the streamline that they qualify for. So most refinances get held up gathering pay stubs, bank statements, and waiting on the appraisal, but this one is built to skip most of that. So confirm your existing loan is FHA insured and current, since this only works on an existing FHA loan. And then ask your lender whether you qualify for the non-credit qualifying version, which skips the credit check. So in most cases, you won't need a new appraisal or income documents either, though investment properties are an exception and will still need one. Know that you can't take more than $500 cash out throughout this process, since this one is built to lower your payment. Special side note, that is not allowed in Texas no matter what. You're not allowed to take cash out using the Streamline refinance with FHA in the state of Texas. Every other state is perfectly fine. If any of these seem like the path that fits your situation, whether that's a low credit score, a fixer-upper you're eyeing, or an FHA loan you already have sitting at a rate higher than what today's rates are, use the link below to book a call with my team. These conversations are most useful before you've made any decisions, while there's still time to look at every option without any pressure. And if you want clear, researched-back explanations of how mortgage programs like these actually work, hit that subscribe button. Next, watch the one where I break down what to know before using a construction to permanent loan. It pairs perfectly with what you just learned. My goal is to help you make informed decisions with confidence and ultimately win with Wade.